And with that, ladies and gentlemen, we are moving right along. Now, this past couple of years have seen no shortage of turmoil in the financial world. I think we're all very well aware of that in this room. So fortunately, our next panel is stacked with leaders. Leaders who have not only charted a course through stormy waters, but they have brought their ships to safe harbor and seized opportunities along the way. We are going to have this panel helmed by none other than Arthur Yuen, the Deputy Chief Executive of the Hong Kong Monetary Authority. And on this super stacked panel, we would like to welcome Mr. James Gorman, the Chairman and CEO of Morgan Stanley, Colm Kelleher, the Chairman of UBS Group. We are also going to welcome to the stage Mr. Bob Prince, the Co-CIO of Bridgewater Associates, and to round it out, Christian Suing, the CEO of Deutsche Bank. Gentlemen, please run, don't walk. Let's get you on stage and ready for action. Now, Arthur is going to be reachable by you. On your tables, there are documents with QR codes. You'll see the QR codes, and what you can do is scan the QR code. That will take you to a page where you can put a question that will go to our offstage moderators, and then right here to our main man, Arthur Yuen. So if you would like to get a question in, the QR codes are on the table and ready for action, as are Arthur Yuen and our panelists. Take it away.
Thank you very much. Good morning, everyone. Good morning. It's so good to see all of you here, so many familiar faces. Thanks for coming back to Hong Kong. And we have 4 very distinguished panelists. I don't think they need any introduction, although the MC has introduced them. But gentlemen, we have been given a very direct topic for this session. We are asking you to look into the crystal ball and tell the audience what you think the next crisis will look like. Now, if I put that questions directly to you, I think we can finish this panel in 5 minutes. But being a banking supervisor and having some senior bankers on stage, certainly I wouldn't let you off stage or off the hook that easily. So what I suggest doing is I'll put the questions to all of you individually to talk about what you think the market dynamics, how the market dynamics are changing. And on that, we do have a very convenient starting point. That earlier in the year, in March, April, we have actually seen a round of banking instability around the world. And that provided a convenient starting point for some of these discussions. So what I would do is I hope you can share with us your take on how you think what we have seen back in March, April, are indicating changes in market dynamics and how those changes are shaping the vulnerabilities in the markets so that when the next crisis hit us, we can get better prepared. So talking about March, April, if I may start off the session by putting the first questions to Christian. I hope you don't mind me starting with you. Back in March, April, indeed for a short period, you and your bank has experienced changes in market dynamics in the form of the impact of social media. I just wonder whether you can quickly take us through how you actually managed to change the narrative around that quickly, around that time, and do you think social media impact on market dynamics are really something that we should really watch out for more closely going forward in terms of vulnerability assessment?
Yeah, thank you very much, and first of all, thank you for the invitation. Look, it's certainly a situation one does not like to have, but on the other hand, I'm coming from the sports. That's where you are practicing and training for, and I think that's why you're doing all the simulation and stress testing, which is obviously also a key demand from all of our regulators. In essence, I think the way we dealt with this was, I'm always calling it's 4 items. You know, it's all about an adequate, robust capital position, sufficient liquidity, and when it comes to sufficient liquidity, I think it's in particular based on a broad and diversified deposit base. And last but not least, it's all about a sustainable profitability. And this was all what we tried to do over the last 5 years in turning around Deutsche Bank. And with that, what we did over the last 5 years when transforming this bank into a sustainable, profitable institution, Arthur, I was always convinced that this, in my view, unjustified market attack, and you know, most of the people know how it was built up on a Thursday night, that people who are smart and look into that get the deal and know how robust this bank is. In particular, if you look at the capital, liquidity, the broad deposits, and the sustainable profitability of the bank. And this is exactly what then happened on the Friday morning, that analysts, rating agencies came out with factual reports, and with that calmed down the market. And what I learned on top of that is, obviously, it's all about the monitoring of your own liquidity and deposits. You need to be very close to it. And you need to be close to your clients and close to your own people. We, on purpose, decided at Deutsche Bank not to do any public statements. I think in a situation with social media and like that could have even worsened the situation, because we had the inner confidence that we are close enough to our clients to deal with that. And at the end of the day, I think the 4 items I just described really made the trick, that that situation calmed down after 36 hours.
Yeah, thanks, Christian. So what you're saying is that, first of all, we need to have a good story to tell, and then you have to manage that process very effectively in telling that story. And you mentioned that we only have 24 hours to respond to it. And indeed, I think there's a very important lessons that we've learned from the March incident, that the response functions of both the banks and the regulators or banking supervisors have been compressed so much these days. But thank you very much, Christian, for your sharing. Let me next turn to Colm. You are clearly in a happier seat back in March, although it's still a very trying circumstances at that time. But you really have a front row seat in that. Can you just, I know this is quite a tall order to ask you to talk about it in a few minutes, but can you really share with us how you steer your way through that trying circumstances back in March? And in terms of the overall European sort of banking situation, is everything well now? Any risk factors that we should watch out for?
Well, I'm not sure about a happy seat. It was very clear that we at UBS did not want to do the deal initially. We had our own strategy, which we felt if we executed on would have been massively price book accretive. However, we were watching what was unfolding for a year, and by October 22, it was clear that Credit Suisse, in our opinion, was a total falling knife at that point. So given that we felt that we would get a call potentially, not necessarily as the takeout, but certainly as a validator, as a board we got ready and we enlisted the mighty house of Morgan Stanley as our advisors to get ready for this call that we didn't want. And by the way, just for the record, some of you in here wrote me direct letters saying under no circumstances are you to contemplate a merger with Credit Suisse. Now, what happened was we actually did a deal that I think satisfied the fiduciary interests of our shareholders and did stabilize the situation. It is clear that us acting and, by the way, getting the huge regulatory compliance and not forgiveness, but cooperation from regulators around the world, we ended up, I think, stopping a situation from snowballing. And it's clear that whether it was a combination of Silicon Valley, Signature Bank, and then Credit Suisse, there was no contagion after that weekend. So it was clear that things worked. One thing I do want to make very clear is that resolution was something that could have happened. The FSB itself has come out with a report now saying that resolution would have worked. Actually, you would have been left, in the case of Credit Suisse being resolved, it would have been left with a 44% Tier 1 ratio, but there clearly were huge contamination effects from that. And it's from that now that we must learn what to look at going forward. And the 2 lessons I've learned is, one, this was not about capital. This was clearly about business model, and it was about funding, right? So I think the regulators need to focus on funding, expansion of collateral, eligibility of collateral, et cetera, to make sure we get ready for the next crisis, should it happen in the regulated sector. I want to come back to that in a second. But two, on the funding, on the business model, I'm not sure it's the role of regulators to opine on business models. Business models are the preserve of shareholders, management, and the board, all of whom, in the case of Credit Suisse, singularly failed to monitor what was going on at Credit Suisse. So there are certain jurisdictions that look at business models in different ways. As you know, the UK has the senior manager regime, suitability of management. The US has proxies such as the Camel ratings and the OCC assets and earnings, but it's clear that the regulators in Switzerland need to be given more power to opine on these issues whilst also respecting the role of shareholders and so on, right? So I think for us, the big lesson going forward, and the FSB has said this, let us not get confused about capital being the answer. There was more than enough capital at Credit Suisse. That is clearly not the answer, and certainly I think movements from certain regulators at the moment to try and top up capital are misguided. They should be focusing on other issues. I'll answer your question about where the next crisis is later, okay?
Yeah, sure, thanks, Colm. Let me just clarify that happiness is always a relative concept. And I'm sure relative to another Swiss bank, you'll have been in a much happier front row seat. But thanks for sharing, and I think what you refer to in terms of some of the issues in relation to resolution or resolvability or resolution execution, put it this way, is something the international community is actually looking very closely at. I have recently led the peer review on Switzerland on the Too Big to Fail reform program. The report will be coming out soon, so take a look at that. And some of the things that you have mentioned would also be covered in that report. Since you have referred to Morgan Stanley, let me next turn to James. James, you have actually been through different crises. The 2008 great financial crisis, global financial crisis, and then now more recently the March-April incident early on in the year. I have to say that on both occasions there have been talks about a major contributing factor is actually the regulators not getting things right in some major aspects. Do you agree with that? Are there any other vulnerabilities that, having seen what we have seen back in March, April, any vulnerabilities that we should really watch out for going forward?
Well, I think you're a brave person if you're up here criticizing what the regulators got wrong. So I'll just say that. I think they did a spectacular job, actually, for the last 14 years, and sadly I won't be around for the next 14 to cheer them along. You know, I think using the word crisis for both of these is really, it's just not accurate. The first was the mother of all financial crises, and it wasn't just the regulated banks, it was the non-financial sector, it was GE, for goodness sake, with GE Capital. It was every financial institution in the world. And, you know, the only way it could be stopped was the intervention of the governments, because ultimately society is the backstop to the banking system. The banking system operates on leverage, and without having a backstop to that leverage at some point, you'll have failure of the whole system. Now, the objective, of course, is to ensure you have sufficient capital to meet whatever challenges the leverage you have on your balance sheet might bring. And that objective failed, and it failed in multiple jurisdictions. In fact, there are some countries in this world where the governments still own part of the banks. The result of that was the most comprehensive reworking of the regulated banking system in, you know, probably since the 1930s, and has largely worked. I mean, apart from the situation that Colm had to deal with in Switzerland, which had sort of been an unresolved aspect of the financial crisis, and for reasons I don't need to go into. The world has been, from the banking sector, relatively benign. Now, come forward to March of this year, and by the way, I think Christian is exactly right. This is the kind of absurdity that people project from a narrow situation, which was a couple of three US regional banks, to sort of the rest of the world, and appropriately they belted that back. But what we had here was, 3 regional banks who built, back to one of the regulators earlier said about concentration risk, built very concentrated business models, were sort of the darlings of their sector because they were doing sexy stuff. In the case of First Republic, providing very low-cost loans for a lot of people who work for a lot of people in this room, in the hopes that they'd bring their deposits to them, which they did, and then they promptly pulled their deposits out when it wasn't convenient to hold them. Same thing happened in Silicon Valley with the venture community and Signature Bank with the real estate community. So very concentrated groups of clients. This was not a banking crisis. This was a crisis for 3 banks. That's all. And it was cauterized. And by the way, the irony is, maybe it's not ironic, but the part of the solution was for the largest regulated banks to provide uninsured deposits, which put them in jeopardy and their capital in jeopardy, to the tune of $30 billion to help give the regulators, particularly the FDIC, time to resolve the first one that failed before they had to get the third one that failed. So the problem children of the first true financial crisis became part of the solution for the next crisis of 3 banks. And I think the system worked. But as I step back from it and just reflect a little bit, and I lived this with Colm, side by side for a decade, the CCAR, which is the annual health test of banks that's put in place in the US, you could argue has reached a level of detail. In our own case, we submit 80,000 pages every year. CCAR. Somebody has to read it, process it, put it together with the other 32 banks, I think there are, that go through CCAR, and somehow spit out, rational, actionable answers from it. I joke we have 83,000 employees and 80,000 pages in CCAR, and you're in a bad place when your CCAR book is bigger than your employee resume book. But I think CCAR has kind of reached the point of, perfection being the enemy of good. And you didn't have to be a rocket scientist to see that the asset liability mismatch for these 3 banks I talked about, stood out like a shining light. You didn't need 80,000 pages, you needed 1. Yet somehow we missed that. So my encouragement to regulators is to step back and think about it the way boards and executives are forced to think about issues of what matters and what doesn't. Certain things matter. Liquidity matters more than anything, and it matters every single day we get liquidity reports and we study them. Fine-tuning of the 10th scenario under CCAR and trying to predict what the world is going to be, which is going to be your next question, it just doesn't matter. We don't know what the world's going to be. So you prepare for all eventualities. And I think that was the lesson, and I think it's a valuable lesson to take away from the March crisis of a few banks, is we miss the point of what matters and what doesn't, and go back to the basics and look at fundamental liquidity, capital levels, quality of management, strength of the control functions within the banks, the internal audit, compliance, legal, risk, finance, and then see if all of those pieces put together lead you more likely to avoid what are the unknown pitfalls that we're all going to face, the unknown holes, catastrophes, or likely to avoid them, to hit them. And that's what we've tried to do.
I hope your team here has always been telling you that we are banking supervisors that always focus on what matters and what not, and not an over-extraction sort of process of details. But thanks, James, for that sharing. Let me finally turn to Bob before we actually open up the floor for some questions. Bob, you are the only panelist here who's not a banker or representing a bank. So it's good to hear your views on what's your take on the banking situation or incidents back in March, or in James' word, the crisis of 3 banks in the US, regional banks in the US.
Yes.
Another possible question I can put to you bluntly is, we have actually focused a lot of our energy on reviewing the lessons learned from the banking incidents back in March, April, and previous crises. We haven't actually been focusing a lot of our energy on non-bank financial institutions. Could the next crisis come from that direction?
Yeah, could. Yeah, sure. Well, first of all, thank you for the invitation here in this really very important discussion. That prior panel was really excellent. When we think about the causes of crises and events such as that, one of the big causes of those things is when you're in a certain regime, economic regime, for an extended period of time, and then people extrapolate that into the future, and on the basis of leverage and asset liability mismatches and so forth. And then you get a shift in that regime, and that's exactly what we've had, and that's why I believe this question is really relevant and timely. When you look at the events of March, they're a perfect example of that, of the asset liability mismatches. When we look at that specifically, we see those banks at the extreme tail of the poor asset liability management, and that when we look at the rest of the banks one by one, we don't see the same kind of problems existing. There's an earnings drag across the banking industry from being upside down against the bond portfolio, but that's different than a crisis. If I look more broadly at the effects of a transition from really 15 years of abundant free money, which was essentially necessary to battle the deleveraging, to offset the deleveraging pressures in the financial system after 2008 and then the pandemic, we do have a number of residual effects from that I don't know that are particularly acute, but I think that really you should be registering over time, and I would categorize these as some long-term, some medium-term, and some short-term influences from that regime shift. Under the category of the long-term, when you look at U.S. government treasury debt, in 2008, debt to GDP was about 70%, around the level that it had been for decades. And the after effects of battling, offsetting the deleveraging pressures and the pandemic, you've had a massive wealth shift from the public sector to the private sector, and that's left the government with debt to GDP up from 70% up to 120%. And the particular, I think, vulnerability of that is in the debt rollovers and the gross issuance that you're going to see in the coming decades. You're stuck with that debt until you pay it off, and that means you have to roll it over like anybody else does. And the debt rollover, gross debt issuance will be running around 25% of GDP for as far as the eye can see. Now, that means every year you're issuing 25% of GDP of debt. From 1960 to 2008, the average amount of debt issuance was 12% of GDP. So this is not the norm. You can't look at the last 60 years and say this is the same thing. This is different. Rollovers, typically people don't pay much attention to the debt rollovers because you assume that the debt gets rolled over. But actually, if you look at countries who've experienced balance of payments crises, it's typically the inability to roll over debt that is the source of the problem, typically in emerging markets, but not always. And so I think the crucial thing to look at is the holders of the debt, because the holders are the ones that roll over the debt. And in the case of U.S. Treasury debt, 27% of U.S. Treasury debt is held by foreign investors. 18% is held by central banks. Foreign investors would normally be a reliable source of investment, but it does heighten the sensitivity to the geopolitical risk. And so geopolitical risk converges with debt rollovers and the gross issuance of the Treasury as an issue that I think you need to pay attention to in the coming years. It's probably not an acute problem, but it's also a problem that's not an issue that it's going to be with us, right? And then when you look at 18% of the debt owned by central banks aren't your normal buyers of bonds. They did it for policy reasons, and most central banks have their fill of bonds at this point. And so will they roll over that debt? Obviously, the Fed is not doing that right now. They would probably if policy required it. So between foreign investors and central banks, U.S. Treasury debt is 45% of it is held by those two groups. So you have to think about whether that presents a rollover risk. I would say that's your biggest long-term residual issue. Is if I went to the kind of the medium-term residual issues, I think undoubtedly the 15 years of abundant free money has fueled the private equity boom. And while you probably don't see any particular acute issues there, maybe they exist, I think you'd have to figure that with interest rates at, let's say if companies are borrowing at 8% instead of 2 or 3%, that the pace and the transaction cycle is bound to slow. And so that's already started to have some effects. We have, when we talk to institutional investors around the world, many of them are experiencing liquidity issues right now. And the liquidity issues result from the fact that so much money was allocated to private assets, and now the transaction cycle has slowed. And so I don't know specifically what manifestations that might cause, but that's something I'd be looking at. One kind of narrow manifestation of that, I think, is in the leveraged loan market. The leveraged loan market was an interesting market because you could go out and borrow money for 5 to 7 years at term at a very low interest rate, interest only, and you had a bullet maturity at 5 to 7 years. And the basic idea is you pay your interest, and then after a couple years, you just roll it out to a new 5 to 7 year maturity. But as the interest rate structure rose, now you're left with a greater challenge in extending the maturity of that. And so now what we see is in the leveraged loan market and the high yield market that the maturities within the next 2 years are about 16% of that market. The normal is about 8%. So we have a little bit of a wall of maturities there. And I guess I'll stop there. So those would be some of the manifestations that I would be looking at and thinking about.
Yeah, thanks, Bob. I know that we are running out of time, but we have actually, thank you very much for all the sharings, because you have covered quite a wide range of issues, gentlemen. Starting from Christian, you talk about banks must have a good story to tell, basic strength, fundamental strength of the bank. But you also mentioned a very important point of having a way to effectively connect up with stakeholders when the time comes, instead of just relying on social media sort of driving all the narrative. And Colm, you talk about business model risk, the powers of regulators, resolvability sort of issues. And you also mentioned a very important thing, that funding is very important, both from, I guess, from a funding of the bank's perspective as well as emergency funding provisions by the central bank to the banks. There are a lot of question marks raised after seeing the incidents back in March, April. And then, James, you talk about also some of what you said refers to basic business model risk of some of those banks. Bob said that those few banks have been the bottom end of the asset liability management, but basically, if they have gotten the business model right, then it could make it easier for them to manage the asset liability side of things, I guess. And then the effectiveness of the supervisory process, what should we be focusing on? Pretty much what the topic of the panel is about. What crisis are we talking about? What are the factors that we are talking about? And then, Bob, you mentioned some long-term geopolitical, debt rollover type of considerations that might actually be shaping some of the vulnerability points that the debt maturity war that we will be facing soon. So a whole range of issues. I did receive one question from the floor. So it's addressed to Bob. Will the debt sustainability issue in the US that you refer to change the status of the US dollar as a global reserve currency? It has very little to do with crisis or global financial crisis, but indeed there's a fundamental issues. Bob, do you feel like taking that question?
Yeah, well, I skipped over that part when I was describing. I guess it was too obvious. Yeah, well, you have the implication is a potential dollar bond problem, but that could be manifest in the interest rate structure or the currency. The question of a reserve currency is a huge issue. Ray Dalio has studied the life cycle of reserve currencies, and they do come and go over many, many, many years, if not centuries. It's typically the last thing to go, and it's something that you need a good alternative, right? And so it's an issue, but I don't think that you're going to see any sort of near-term loss of the dollar as a reserve currency, but you could more likely it manifests in pricing, right? The interest rate structure and the currency itself, as opposed to the the actual status. But we're headed probably in the wrong direction, though, in terms of quality.
Thanks, Bob, for taking that. We now have only 4 minutes left, so let me turn back to the original questions that were put to us. What do you think the next crisis would look like? As banking supervisors, I always have the motto that there will always be a next crisis. It's just how we get prepared for it. And the period between crises was just a transient sort of phenomenon for us to get prepared for it. So let me go back to Christian. Maybe I can again start with you. Just very quickly, 1 minute, what you think would be the most important risk factors or vulnerability factors that we should be watching out for going forward?
Well, I keep it with James. It's always hard to obviously see the next crisis, but to be honest, I'm nervous about the state of the capital markets, because I think they have been extremely resilient. If you think about what is going on in this world from a geopolitical point of view, still from an inflationary point of view, if you think about where interest rates have gone over the last 12 months, if you then see how resilient and calm the markets are, the crossover is at 420 basis points last night. I mean, this is a level which is, in my view, far away from that what you would normally see in these situations. And my biggest fear is that there is, for instance, one more geopolitical escalation, and that can happen pretty quickly. And the markets at some point in time actually give up their calmness, and then you have a market event. And in this regard, I think we all need to stay very much on alert with regard to risk appetite, stress testing, and simply don't do the mistake and simply think that the markets will remain that calm as they are right now.
Okay, thanks, Christian. Next, let me turn to Colm. Your take?
I'll do it in a minute. This is at the risk of upsetting half the people in the room, some of whom are clients, some of whom are competitors, and some of whom are actually clients and competitors. Since 2008, the number of assets that have moved out of the regulated financial sector has grown by roughly 10%. Roughly 50% of global financial assets are now in what you call non-bank financial intermediaries, the shadow sector. Bob touched on one or two areas where there could be real friction points. I think the next crisis, when it happens, will be in that sector. It will be a fiduciary crisis. I know the FSB is very focused on this, finally, having been told in 2009 by us banks that we were being penalized too much, and they should look at the shadow banking sector. But I think it's a real cause for concern.
Yeah, we called it non-bank financial intermediation now. We have ditched the shadow banking tag some time ago now. James, your take on the next vulnerability?
Well, I don't know what triggers it. I mean, nobody in this room, I think, predicted COVID. It is likely to be something geopolitical/political. I mean, the challenges to democracy in some countries around the world are pretty evident. So that I don't know what is going to predict it, but where the sort of weak link is, I think, is it goes back to what we saw in March, and I think we got a bit of a precursor. The sort of policy objective is to limit the size of large banks and, by implication, support smaller banks around the world, which may be a perfectly noble policy objective. From a practical reality of having these banks deal with the cyber, the regulatory oversight, all of the technology investments one's got to make to be competitive in the AI space and so on, means that they're just less competitive. And when you put pressure on the system, the least competitive player falls back. So I don't think we've got this conundrum of a policy desire against the reality that when the pressure hit, it was the largest banks that came in to help were not hurt. And I don't think until you resolve that, I don't know what's going to trigger it, but I think that's the issue.
Thanks, James. Finally, Bob.
I think probably the biggest thing I'd be worried about near term is that the markets are under discounting how long the tightening cycle is likely to go on in the U.S. and Europe before we actually achieve some sort of equilibrium conditions of a 2% inflation rate with a 2% growth rate, given that so much of that is now entrenched in wages and unemployment and so on and so forth. It's likely to continue on. And so I think you're in this environment of the current level of short-term interest rates in the U.S. and probably higher in Europe for some period of time, and the markets are under discounting that and the effects of it.
Thanks, Bob. And thank you very much to the four gentlemen for your insightful sharing. I'm sure the audience have benefited a lot from your sharing. So let's give them a big round of applause. Thank you very much.